Good Friday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, all the way from the not smoky city of brotherly love, Philadelphia. How you doing, D?
Good morning, Will. How are you?
Great. I didn't bring the disclaimer up, so let me put that up. How's the smog or the smoke down there today? It's actually clear here for the first time in 3 days.
Has it gotten better where you are?
Yeah, way better. It's like a new dawn is upon.
Yeah, I haven't gone outside yet. I'm not sure, so it doesn't look as bad from the window though.
Yeah,
just
and
looking
that's
out.
it's actually you can go out without a mask today. It says in the.
Oh, nice. Okay,
so there you go.
Better. All right, everyone. Before we get started, just quickly read the disclaimer. Will and I, we're Market Chameleon. We're not a registered investment advisor or broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your RIA or your broker. That's what they're there for, to help guide you, give you advice. There's the disclaimer.
Excellent.
Let me share my screen here. And quick note to anyone joining us for the first time. Will and I, we do this show in the morning to help answer questions you may have about the Market Chameleon tools, the data, the analytics. If you want to come on the show, ask your question live. We provide a link to Zoom on the live chat on YouTube. Click on that. Once you get over to Zoom, there's a button, raise your hand at the bottom of the screen. Click on that. Then you could ask your question live and direct. If you prefer to type your question in, you could type that question into the live chat on YouTube. And Will's watching it. He'll read that back to me. And we'll try to get to those questions too. While we're waiting for more people to join and for questions to come in, we'll start out taking a look at the pre-market report. These are stocks trading in pre-market hours up here, and see if we could get some insights on what's going on in the pre-market hours. Then we'll move on to the questions. Okay, so pre-market report over here, we have a list of our most active stocks trading in pre-market hours, our biggest percentage gainers, biggest percentage decliners. Coming down here, I see 61 stocks made our percentage gainers list, 24 on our percentage decliners list. From that perspective, looks like we're setting up for a bullish bias at the open. And I'm going to scroll up here and take a look here on June 9th. So we have a calendar here going back, showing the pre-market, pre-market activity from a high level. So today, June 9th, we see there are 429 stocks trading in the pre-market hours, higher than the previous day's close, 260 stocks lower. If we look at the volume, there's 90 million shares traded up in the pre-market, 39.4 million shares trading down from previous day's close. And if we convert those volumes to dollar value, $3.4 billion worth of stock traded higher than yesterday's close, $617 million dollars worth of shares trading lower. So far, all these indicators are showing positive sentiment at the open. We could scroll down here, and we do see this list of stocks here. We do include anything really that's listed on the major U.S. exchange and it's trading in the pre-market hours. If it meets our thresholds, it can make this list. So you have small cap stocks in there, ETFs, leverage products, any security. So let's narrow down and filter this list to a smaller group of stocks. To do that, we'll use the filters here above. I'm going to click on this one in ETF. Clicking on that gives us a drop-down menu with a list of ETFs to choose from. The top ones our broad-based ETFs. Then we've got some sector ETFs here. Let's click on SPY, and the list below gets filtered by stocks that are holdings in the SPY ETF. Okay, here we have 11 stocks up, 2 down. This also points to a more bullish bias, positive sentiment at the open. It's not a very huge list, but nevertheless more bullish than bearish from every direction. The one that sticks out maybe is the top one, Tesla. I think they had some positive news yesterday after the close with General Motors.
It's interesting how that's going to play out. I mean, we do have Laurent on, who's a Tesla owner and a big has been very happy with his Tesla. I think even he may have got a second one and installed solar on his house because of it. But anyways, those Tesla stations are going to become pretty crowded, right? I mean, they're already supposedly can be lines when you go to charge. You know, you have to wait and get in. Now you're going to bring it on both Ford products and GM products. It seems like it could.
They'll have to
be an issue, or they have to expand, right?
They'll have to expand them, and I guess the good news for Tesla is that they might become the standard of these, rechargeable stations. And
well, that's great news, right, for Tesla? Really, I would think. I mean, really, it's a revenue. It's a revenue source, and if they're the standard, really good.
I think that's really good news for them, because now you're not talking about just selling the Tesla vehicles, but are they basically replacing like the old gas stations, right? And they'll be the standard for recharging cars. So I think that's really good news for Tesla. Let's take a look actually while we're on there, unless we have any questions.
Well, we don't have any questions. Sarush was wondering if there are any out of the money calls that show up in Teslas when you do if you can screen for them. But that was only, it wasn't really a question. Right. It was just making a statement about Tesla. Maybe one way to play it, right? Maybe look, if you're bullish, maybe one way to play it, or you can credit spreads or something.
Yeah, these were the trade ideas from yesterday. So keep in mind, we're not open right now. So the options markets don't open till 9:30, even though the stock is trading in pre-market hours up 6%. Option markets are not yet open. They'll open only at 9:30. So we could only still reference, previous day's close. But these were yesterday's, filtered out top 3 edge ideas, bull call spread, and two long calls. I think this one, the 245 call, right, that was out of the money yesterday. So based on these trade cards, just looking at this, it looks like that the implied volatility was relatively low. That's why these are generating trade ideas. And of course you could drop this down and look for different trade ideas from here, and these are based on our algorithms scanning the markets, running theoretical values of what we think these either strategies like a bull call spread or option, in theory, what it's worth based on how historically this Tesla stock moved. So it's looking at distributions of returns, and then it's comparing the market price. It's comparing market prices versus theoretical values, and if it looks like it's at a discount and it has a theoretical edge, it generates these ideas, right? And you could click on and read more about them by clicking here. So if you wanted to read about this stock behavior, payout diagram, so forth. You could go into here. But let me close this.
That's awesome. D, we did have actually, Lauren actually has a question.
Yeah.
So do you want to go live with Laurent or keep going here?
Yeah. If he's going to come in, sure.
He's coming in live. Laurent, I'm letting you in. Obviously, there's a little bit of a delay between this announcement and you hearing it on YouTube. But if you're on Zoom, so Laurent, you're coming in. I'm allowing you to talk. Remember to turn your mic on. Thanks, Laurent.
Hi, good morning.
Hey, good morning, Laurent. How are you?
Morning, Laurent. Thanks for coming in.
I'm fine. Thank you very much. I'm calling to express my gratitude to Dmitry and to you, Will, also, and for the quality of the website, but also for the morning shows. And that's the first thing I want to say.
Oh, thank you so
very much for your help.
Thank you, Laurent. We really appreciate it.
Yeah. And then secondly, it's a short question, but I've been thinking about that because when we sell premium, we are basically selling volatility, meaning we are playing the realized against the implied. But how meaningful is realized volatility? Because realized can really be high, but the price can really revert back to, let's say, in between strikes. Whereas when you set up a trade at 20 deltas or 15 deltas on both sides, you really put these fixed strikes, right? Whereas whereas realized can really go anyway. It can be higher and can yet return between the strikes. So I was just wondering how you would look at that and how you would compare that, like, historic vs implied.
So the question is, how do you compare the realized volatility to the implied volatility? Is that correct?
Yes, correct.
Yeah.
Because implied is fixed and realized directionally can return to the mean or to where it started.
Well, yeah, but volatility is not directional, right? So volatility is the fluctuation of the
No, but when you use strategies defining, let's say, a 68% chance by going to 16 deltas, even though realized can get higher than what you have, let's say, statistically implied, the price can return between your strikes. So how do you look at that? Like, it can be a higher realized volatility than implied was underestimating the volatility, yet price-wise it remained the same.
Right. So the way volatility, or when we look at volatility, it's a measurement of the fluctuation in stock prices. It's the log return, right? We take it, it's the log return averaged out. Okay, so if you take a stock that went from 100 to 110 and back down to 100, so the stock itself is unchanged, but it experienced high volatility because that's a 10% move, right? So the volatility itself is a measurement, and there's no way to exactly measure it because it depends on the price points you're looking at, right? The realized volatility, right? It's a measurement how much the stock price is moving around.
That is correct. But the question is, when you look at the graph of historic vs implied on your platform, I understand that the realized volatility was higher, but it has no effect on whether the strategy was a winning strategy or a losing strategy. It just says that volatility has been underestimated when historic is higher. Yet with higher realized volatility, your strategy might still be making money because you never know. I mean, anything can happen, obviously.
Right. And so it's a good question, because if you compare implied volatility versus realized volatility, it doesn't indicate if your strategy made or lost money, because that will depend on the actions that you're taking. The strategy itself of trading realized volatility means it's not like sitting on a position. It's not the same thing as you invested in a stock and you're waiting and then you sell it. It's actually a trading strategy, meaning you're trading gamma, you're taking actions, you're doing things to manage your position. So the points you're doing things could be different than somebody else, right? So if I hedge my delta, at every 500, somebody might do it at every 1,000, somebody might just do it at the end of day. So the way you're managing position will differ across the board. There's no exact, not everybody manages everything simultaneously. So there's no way to say if I traded my gamma and implied volatility, would have I made or not. For instance, when the example we used, if a stock moves from 100 to 110 and then moves back to 100, if you did nothing, right? If you just sat on your straddle and did nothing, you probably decayed and lost. But the person who, when the stock went to 110 and said, whoa, I got this long delta now from my straddle, I need to sell, 2,000 shares of stock, and then the stock goes back down to 100, you're like, whoa, now I'm short this delta, I got to buy it back. Well, they just did a realized flip of $20,000, and let's say the options decayed 5,000, they netted themselves a $15,000 realized gain, right? Realized versus implied.
Yes.
So the strategy itself of trading implied volatility involves active management of a position.
Yes.
And that's going to be different across the board, right? So there's no way to tell how you would have performed by just looking at the past, because you're making your own subjective decisions how to manage that position. So for sure, you cannot just look at a chart and even if realized volatility looks higher than implied, or the other way around, it's not possible to then estimate that your actual.
No, that was my point. By looking at the graph that you are showing right now, which is comparing historical and implied.
Yes.
In the implied, you have fixed strikes. So what you're saying when you're setting up a position, whether you're selling a strangle or buying a straddle, doesn't really matter.
Right.
You're just setting strikes at a certain deltas, right? Then you look at historical, you see, oh, it's higher or it's lower than what implied had suggested, which is from a volatility point of view, 100% correct.
Right.
But then the realized is really moving. So even if the realized is a bit higher, if it moves back between your strikes, even though it's been higher, it doesn't mean that the higher volatility, realized volatility, would end up in you losing money on the trade. So there are possibilities of making money on a trade, even though the realized volatility is higher than the implied volatility, even if you had sold the implied volatility. That's what I mean. So it's hard to look at this and say, oh, realize is higher, then it's not a good strategy to sell volatility.
Yeah, that's of course not. The chart itself is trying to map out how close, how far they deviate from each other, right? So if you had implied volatility that was priced so extremely higher than the realized volatility, then it would almost be impossible to buy those options, and because they would just be priced way over, right? And it would be impossible. Or if the implied volatility was way lower
Yes.
the realized volatility, it would be impossible to sell those options and probably, would be because they would just be priced way too low for way too long.
Yes.
So the idea is to map out and see how much or how far they've deviated from each other, to get a sense of like, how far apart they are and how they move,
Yes.
as well with each other, right? Does
I
one
understand.
beat the other? And because volatility can come in or go up, right?
Yes.
And you're watching how both of them are reacting versus each other. So that's kind of like the point of the strategy. But there's no way to, like, for example, say over here I should have been long, over
No.
there short, because yeah,
That's what I meant.
how
Yes.
you're managing your position. But when we talk about implied volatility, there are a few things people need to understand when you're trading implied vol. And here I'll bring up the implied volatility itself. It's an estimate, right? It's an estimate from option prices. It's using an option pricing model to say, well, if the price of the option is this, then the implication,
Yes.
it's implied, right, that volatility going forward, this is what the volatility will be. That's it. It doesn't, it's an estimate, right?
Yes.
It's just like a really estimate based on assumptions of the model. Just like if I take a stock price right now, I could take Tesla and say, well, based on Tesla's market cap and this and this and this, the market is implying that Tesla revenue will grow by 50% per year. You know what I mean? So I'm just estimating it through a model by giving other assumptions in there and saying, well, if all these assumptions are reasonable, then this is what I think the implied volatility is. Just like I could try to map out, this is what I think the market is anticipating, a 50% growth rate in Tesla, right? That's
Yes.
working backwards through a model. But I don't really know what everybody's thinking. I'm just saying that's what the prices are implying, right? But when we talk about implied volatility, there are weaknesses in the model. And the implied volatility, it has a log normal distribution, right? Function. And then it has a constant volatility.
Yep.
These assumptions make them, and these are just inherent, if you run it through an option pricing model, these are the assumptions, that's already in there. And these aren't necessarily true, right? And actually, they're not true. They're just true for a lot of the time, for most of the time, but not in every scenario. But it's the best model you have. So you have to deal with it and tweak it. And what will happen is that, when we look at volatility, it's also, it's path dependent. Let's call path dependent. Like, for example, what Tesla did today, up 6%. Right. So moved really quickly, right? Yesterday it closed at 234.86. Now it's up 6%. Well, this in the option pricing model world does not exist. That is never priced into the implied volatility, because it always thinks that a stock cannot move, right, from this point to this point without first trading at every penny up, right? It has to trade every penny in between, because that's how, here, let's take a look. If you draw a bell-shaped curve, here's a bell-shaped curve. So let's say, the stock yesterday closed right here, right? Right here, right in the middle. So to go, for it to move up, right? Let me just draw this. For it to move up, right, to today's price. Let's say that today's price is, somewhere right here. right? Well, to move up, it had to trade every price in between because the probability of this price, right? The probability of it moving to this price is higher than the probability of it moving to this price.
Yes.
Right? Because it's closer. Every price that's closer to the is a higher probability than every price that's further away. Right? Because it makes some sense. You know,
In my opinion, I think that is why the zero DTEs have so much success. Because you can put your butterfly or whatever you want at any price point, and you know it will go tick by tick.
Yeah, the zero DTs don't have the gaps in between the day.
No.
Right. So they will probably they will look more like this kind of distribution. But stocks experience these kinds of gaps a lot of times, you know, during earnings or so forth. So the implied volatility is not, it doesn't make sense because what is implied volatility? Implied volatility is an output from a model, right? But the model doesn't know how you're using it or how you're trading it. It doesn't know if you're using it wrong, right? It just gives you an output, right? Here it is. You know, you put things in and then the model gives you an output and that's it. So you have to be careful with the way you're using implied volatility, the way people scan it. And really, you know, the further strikes you get away, the less implied volatility is meaningful because then you're trading. At that point, you're trading tail, right?
I try to stay at around the 20 deltas, which is a good combination. I believe it's my personal opinion. It's a good combination between playing still implied volatility sufficiently enough, while at the same time giving the underlying enough space to move around, trying to avoid binary events, obviously, like earnings. This is basically most of what I do.
Right. Well, so the further you go, the more you're playing the binary, right? You're saying that there's less chance of a binary event happening. So think of it as like that, you know, further and further out you go away from at the monies, the more the implied volatility is less relevant.
Yes.
There you're really then saying that, is there going to be some kind of, you know, event or news that will make it move like this, you know, make it move like Tesla just did, right?
Yes.
Like here, I'll just take a quick look at the order sentiment yesterday here. I'll show you guys. You know, I'm already like, I'm anticipating what probably happened, but you know, we have the deltas. So there it did look like people were more bullish. When I come down, but that could have also been because, you know, Tesla was rising at the same time. But when we come down here, right, here's where we see that a lot of the deltas, bullish deltas were, you know, there are more put selling than put buying. There's more call selling than call buying. And it all happened here on the expiring options. Look at the top ones, June 9th, right? All of them expiring today. So what we see is there's long deltas that came from the at the money. Where was it? Where was the stock? Right? The at the money, basically the at the money puts and at the money calls, right? They're selling a lot of selling of options going on around the options that expired today. So look what happened probably. They probably pushed this down and now they're covering, right? Now they're racing to cover. So here's June 9th. This is yesterday's activity. And here's where the straddle went out. They were betting on a move that's less than 2.5%, where the stock would stay in the $6 range up or down.
Yes.
So obviously, this is not even implied, you know, because you can't trade implied vol, right? At this point, the stock's up $15. So all these people have to cover, you know, they're already there's no trading of realized vol. They're just, that's it. You know, they sold the option, they're buying it back. Implied volatility has nothing, it's a loss no matter what implied vol does. Implied vol will go to zero today. It's still a loss.
Mhm.
because the implied
Yes, I don't.
vol, yeah, those options, yeah,
But
it-
but
it's
looking
not
but
gonna,
looking at it from looking at it from a quantitative standpoint, these
yeah,
models they have sense, right, over the long term. I mean the implied volatility models. So playing them often enough would probably because this is obviously an accident, so to speak, with such a big gap at the opening. Playing
yeah.
them long enough, these statistical probabilities will be realized in the end if you play them often enough.
But knowing though how the model trades, right? It's the way you're trading it, right? When
Yeah.
we're talking about it, like for example, not around earnings, right? It's
Yes.
not going to
No.
work because
Mhm.
it's not an appropriate model, right?
Correct.
The model doesn't know its earnings. It's just you're just
Yes.
inputting, you're inputting option prices in there, but the model doesn't know,
No.
oh, there's like an earnings event. It just spits out an implied vol. So if you're trading the model and you'll understand,
Yeah.
the model, how it works and how to use it and how to trade it, then then you could get a statistically edge, but you have to really understand it. It's
I
also,
understand. Mhm.
yeah, because
Yes.
volatility is also, it's not constant, it's path dependent, right? We
Yeah.
know that
Mhm.
as stocks, rise, they rise slower than they move
Yes.
down. Obviously not like this,
Yes.
today, because that's a big gap, but they'll they're rising slower, meaning
Yes.
that the volatility itself is not constant. It's moving, it's it's moving
Yeah.
lower as the stocks rise, moving faster as they go down.
So thank you very much, Dimitri, and
Yeah.
enjoy your holidays. As I
Uh,
understood, you are taking a holiday, much
Yep.
deserved,
So
I suppose.
next week I'm gonna do like Monday and Tuesday, but next week I'm leaving on a trip to uh Europe actually, so I'm not gonna be able to do the show.
If
But
you
when I come
come
back, we'll start.
if you come through Belgium or the Netherlands, you
Oh,
can always contact me.
oh, thank you. Yeah, I wish I'm going to it's gonna be in Italy and Greece.
Okay, in the nicer places of Europe. All right.
Well, no, they're all of Europe is nice. I've never
Yeah.
never been to Greece, so this would
Okay.
be the first time.
Thank you very much. Thank you very much.
Lauren, I'd be interested. I don't know, maybe next week if you came on, I'd be interested in your thoughts on Tesla. I know we're well over, but you're the person we know the most.
I'm just driving the car. I don't have I don't have any positions in Tesla.
What do you think? What do you think about the actual charging stations? Are they easy to access now? And are you
Well,
worried about other brands now coming into the charging stations?
I have no idea because I have mine in my house, in
There
my
you go.
garage, and I just put on solar panels so that I would charge for free. And as you said before, I have two, so yeah, that's easy.
Oh,
Makes
that's
driving
awesome, Lauren.
even cheaper.
Yeah. All right. For those who don't know, Dimitri's going to be going away on vacation. I think the 19th is that week and the week after when you're gone, right, D?
Well, no, before that, I think we're gonna be 17th, I believe. Or I gotta look again.
Well, whatever. We'll
Yeah.
look. But next week,
Yeah.
we actually have the interactive broker webinar on Tuesday.
Yep.
So we'll be doing the show most of next week. And I am working on trying to get dates for the show. I know I don't want to tell people who are coming on, but there are going to be some blasts from the past who will be joining me. And we're going to try to put on as many days as we can while Dee's away. So everyone can come in, still ask questions and communicate to each other. And we'll at least have a half an hour together as many days as possible while Dee's away. It won't be the same, but we'll give it a go. Thanks for everything, Lauren, for coming on.
Thanks, Lauren.
Dee,
Really
great job
appreciate it.
as always. We're 3 minutes into the opening. Thanks for the Chameleon community for joining today. Thanks for Lauren for coming on and asking this question live. That's always the best type of show. Awesome job, Dee.
Thanks, everyone. All right. Have a good
Have a great
weekend,
day.
and hope to see you guys Monday. Everyone stay safe out there. Have a great trading day. Again, big thank you to Lauren for coming on the show, asking questions. We really appreciate it. And hope to see you guys next week.